G'day and welcome to this week's video. My name's Robert Gowdy from Consortium Private Wealth, and just thought I'd go through some of the things I've been thinking about in terms of quality of business and just some of the key factors of what I'm looking for and what I'm not looking for. Now, I've done variations of this in the past, but what I've done this time, I've always been quite negative on Telstra, have been for 15 years, and our clients haven't owned it for that time, and given obviously the share price has come down substantially, I thought it might be worth re-looking at telecommunications, data. I know their services around Office 365 are part of their packages now. Is it worth re-looking what Telstra have done? And the first things that I'm going to look at is really around earnings growth and earnings per share growth. So really increasing revenues, increasing profit. So if we go to the screen now, we're using Stock Doctor here. It's one of the subscriptions that we use to give us a bit of an outline of the businesses and the key fundamentals. So we can see here we've got the revenue growth line, and so we've got, how many years is that? 1, 2, 3, 4. So we've got 8 financial years there, and 5 out of the 8 have actually seen negative revenue growth. And for the 3 years they had some positive growth. You can see here it's very marginal. And for the 7 out of the 8 years that earnings per share growth has actually been in decline. So looking at the face value of it and what's happened in the past is a bit of an indication of what's happened in the future. There's nothing here I see that wants me to change my mind. Chasing dividends, and you can see here, as we've always had with Telstra, as a general rule, we've had obviously a very strong dividend, and it's around 4.5%. So if we start comparing that to a term deposit, which is 0.91%, it looks really attractive, but it's not attractive if the revenues and profitabilities going backwards, and that's one of the key ways to value any asset. So high dividend, but it's no fun when the share price is going down, which can clearly be seen here. And it wasn't that long ago that it was at $6, and now it's trading at below $3. So one of the key things we're looking at is revenue growth and also earnings per share. Return on equity, of course, is a key factor. So again, if we have a look at another business, and again we'll look at Magellan Financial Group, it's one I've reported on quite a bit in the past. You can see some very strong revenue growth in percentage terms, and in percentage terms the earnings per share is growing substantially. Return on equity is insane, and we know the share price for Magellan has gone from 10, 20 up to mid-50s in recent times, obviously a bit over $55 now, or in fact coming up to 58. Today's been a good day. Another positive one to look at is CSL. Again, very low dividends because there's very high reinvestment, but return on equity extremely strong, and there's been consistent revenue growth all the way along. So I'd just encourage everyone to not focus on dividends, as it's quite a blunt tool in isolation, and it talks nothing about the quality of the business, the sector they're in, the payout ratios, return on equity. So look more closely at return on equity, revenue growth, and earnings per share growth, and what's happened over a duration of time. Do not focus on dividends. That can be a trap. The old yield trap is alive and well. So consider those things. Look at what's happened in the past. Consider the industry. Is it scalable or not? And these are key determinants about what a business is doing and the quality of the business itself. And of course, balance sheet. So there's some of the things I'm looking at, but I suppose this video came about because I thought I'd better have a re-look at Telstra, and I'm still not overly impressed. Thanks for listening. We'll see you next week. Cheers.